Investors Business Daily, William O'Neill, states that you should, as an investor, sell a position if it's up 20 to 25%. It's the 20 to 25% rule. Just because something's up 20 to 25%. Thoughts on that?
Well, what if everything else is up 20 to 25%? You're going to sell everything? So it's the same thing I talked about earlier. It's all relative, right? Just like, price appreciation should be viewed relative to other metrics, earnings, for example. Anything within a portfolio construct should be viewed with relativity. If a stock is up 20 to 25% off its low or off a base per se, what has everything else done over that period? Is everything in its industry or in its sector showing the same performance trajectory? Because that's really what it boils down to for me.
And I would add, it's relative to the size of your portfolio. So if I have a $5,000 position that's up 30%, but I have $1 million portfolio, that's not necessarily going to radically change my goals if that goes down. So I think that's a big one. I think it's just position size relative to the total pie. It's like the ability to take risk. Someone who has a large portfolio can take a bunch of little risks, whereas somebody with a smaller portfolio, maybe they're just starting to save, they have all their eggs in one basket. That's the person that, hey, things are up 30%. Maybe we really do need to diversify.
So I think of it, and it's really important from a client perspective. But I think you have to zoom out. You have to zoom out and say, the position that I have, it's up. And you have to look back at price history. And why is price important? Price is important because it is the exact meeting point of where supply and demand intersect. Supply and demand is price. Okay, so when something is up 25%, that you look back over time, and let's call it Rivian. It was Rivian that IPO'd and jumped up, had a huge jump, but then has crashed way, way down. Well, if Rivian at this point goes up 20%, it's going to be at a price, looking back, that has traded at that level in the past. There has been an intersection of buyers and sellers at that price at some point in the past. And from that, we can glean information on how to act or react. So this is the principle of polarity. Polarity is these horizontal lines on a chart that can act as resistance. So if a stock sold off in the past, when it gets back to that point where it sold off in the past, it might sell off again, because it's proven that is a key price level that investors have wanted to sell at before.
So Dan, for example, $50 a share, right? A stock gets up to $49.99, can't get through 50, goes from $49.99 to $40, and then tries again back to get to 50 through 50, and it fails and stops at $49.99.
Yeah, that's a good example of 50 being resistance. But let me ask you, why would the price go down from 50 to 40? What takes the price down from 50 to 40?
Yeah, there are less buyers than sellers, people not willing to pay as high of a price, right?
Yeah, there's more sellers than buyers, right? There's more So if sellers are showing up at 50, we know that the market isn't comfortable necessarily with pricing beyond 50. And so the market participants sell off. And that to us, again, is information. It doesn't mean that it's the only way you make a decision, but you have to look at price history at these levels to help you make a decision before you say 20% is a profit level to lock in your profit up.